Would you want to be an investor in retail stocks, consumer discretion?
Well, that's not an area that we're focused on right now. Would be prefer to have more in technology, and some of the media or, if you will, communication services companies would be more preferable as a portfolio manager. They are somewhat less exposed to the goods side of the inflationary pressures, which we're seeing. So if we want to think about a way of attacking the market right now would be to separate services companies compared with goods producing. So services providing compared with goods producing companies. You want to be long on the services end and want to be short or underweight or avoiding some of the companies and industries in the more goods focused areas. So think about that specifically on the long area. Services providing companies would be software companies, would be some of the media companies. You look at the banks and financials. Those are areas where they're less exposed to both tariffs, input costs, et cetera. And on the other side, if you're looking at from a goods perspective, you would look at be concerned about some of the companies in pharmaceuticals. You look at energy, would be more focused there.
And we're putting up a chart right now that you provided.
Yes.
It's showing exactly the outperformance of services for good. And there's something of a double whammy because you also have charts in there indicating that the S&P is shifting over increasingly towards services from goods. It's as a larger portion of the population.
And this is a multi-decade evolution, as you see, but not just the index, but the economy become more services oriented. One of the benefits or attractions of services right now is that 80% of the revenues of these companies, these industries, are domestically facing, as opposed to the goods producing companies. Something on the order of almost a little less than 50% of their revenue exposure is international, and that's certainly one issue that's at risk from a tariffs point of view.
Well, fair point. And there's also another chart that shows U.S. equities that have exposure to China, that sell into China, and what their performance has been. And so you have two prongs. It's like, one, you get the companies that are selling into China, and then the companies that are buying from China. And here you see the underperformance of those that sell into the country. The chart right there. So
yes, there we go. Yes, the chart is certainly a big area of risk. So what we see here on this chart, the lower line, what you're seeing is the relative performance of Chinese stocks that are selling primarily into the United States. That's a relative performance versus the Chinese market. So you see that for last year, those stocks underperformed the Chinese index by 25 percentage points. That is an index that went down 30%. These companies were down, the share prices are down 55% in the wake of going into the whole discussion of tariffs. This was basically last year. And as the discussion in political in both Beijing and Washington was about reducing some of those trade tensions, those stocks started to recover. And now, of course, that's now reversed more recently with the increase in trade tensions.
So if I'm a services company, I may not need to worry about it as much. But if I'm a goods company, then I have to worry about the tariffs and what's going on. And one of the things that both Alex and I find really helpful, you go through a lot of the earnings calls and say, what are the patterns? What are people talking about? I'll quote just one of them for Walkwell that you had in your report, which is, with respect to tariffs, we remain on track. But went right past it. But remain on track.
Said something about some supply chain
yeah, basically to neutralize incremental costs through supply chain changes and negotiations with vendors, as well as targeted price increases affected products. So there you have it. We're going to change our supply chain, perhaps, right, as well as absorb some of the costs and pass them on. Are they changing their supply chains?
There are many companies that are in the process of both exploring that and actually implementing that. But some of those changes take time. You can't just pick up your factory or move it to a different location. So that basically diversifying your supply chain it takes time. But yes, companies are absolutely focused on this because the tariff is a legitimate issue and could be there for some time. So
question, I mean, if everything gets resolved tomorrow, pretend, does this conversation from earnings companies change? Or do we imply that the China-U.S. tariff will just be in some way ongoing and some of these companies have to factor in medium term?
Well, the tariff issue is a very specific issue. Could persist, could not. As a investor, it's very difficult to model Donald Trump as a variable, right? You can look at fundamentals, et cetera, but the question, you could have the tariffs, you could not. You could have a resolution. That's its own issue. But the broad issue of labor inflation is going to continue to be here as long as unemployment rate remains at these very, very low levels. Again, that's a good thing from a social point of view, but it is a pressure on a margin. Some companies are better able to absorb that, and that development of more services-oriented, not just economy or the equity market indexes, that is a positive from those companies that are just less challenged to have by higher margins, less variable margins. margins. That's a better business model for dealing in this environment. They're able to adopt and include technology more as well. It's another way of keeping their margins high. Companies have been very successful for the years in slowly increasing margins, and clearly tax reform, lower tax rates, has offered companies another boost, about 100 basis points in margins in the last year.